Good afternoon. Can you hear me? Sorry to interrupt your stimulating conversation. My name is Ezra Zuckerman. I am the Deputy Dean of the MIT Sloan School of Management, and it is a great pleasure and a privilege and an honor to welcome you all here this afternoon. What I want to welcome, in particular, I want to welcome the various assembled here, including special friends and family of Bob Merton here to MIT Sloan here today. I want to welcome the various supporters of the Donald Sussman Award here today. And great turnout here this afternoon. We've got faculty, we've got students and throughout MIT Sloan, throughout the MIT community. And it's great to have you here this afternoon. The S. Donald Sussman Award was established in honor of Donald Sussman's 30-year career in alternative investments and fund management that focuses on both quantitative and fundamental strategies. Donald Sussman is the founder of Trust Asset Management, Paloma Funds, and New China Capital Management, LLC. The Sussman Award is given to an individual or group who best exemplify Donald's impressive career as a successful investor in quantitative investment strategies and models. In a moment, I'd like to invite up here to introduce Bob Merton. I'd like to introduce Bob Litterman, who was the inaugural recipient of the Sussman Award in 2012. Before I do that, let me tell you a little bit about Bob Litterman. So Bob is the chairman of the Risk Committee and a founding partner of Kepos Capital, a systematic global macro firm. In 2009, Litterman retired from a 23-year career at Goldman Sachs Company, where he served in research, risk management, investments, and thought leadership roles. While at Goldman Sachs, he spent 6 years as an external advisor to the Singapore GIC Board of Investment and Risk Committees. Bob co-developed the Black-Litterman Global Asset Allocation Model with the late Fisher Black, and headed the firm-wide risk function and the Quantitative Investment Strategies Group in the Asset Management Division. In 2012, Bob was named the inaugural recipient of the S. Donald Sussman Award. In 2008, he received the Nicholas Molodovsky Award from the CFA Institute, as well as the International Association of Financial Engineers, Financial Engineer of the Year Award. Bob earned his bachelor's degree from Stanford University. We won't hold that against him here, as well as his PhD in economics from the University of Minnesota. So it's wonderful to have Bob here today as the inaugural recipient of the S. Donald Sussman Award to introduce Bob Merton, this year's awardee. Thanks, Bob.
Well, thank you, Ezra, and it's a thrill to be here today. That was quite an introduction for someone just to give an introduction, but it's really a pleasure to introduce Bob and just to say, look, as the first recipient of the S. Donald Sussman Award, we've now really raised the bar. So it's really quite nice to have the second recipient be such an esteemed person. I first met Bob Merton 30 years ago. I don't know if you remember that, but Jose Schenkman was a young economist who joined us at Goldman Sachs, and he said, Bob, we've got to go up and talk to Bob Merton. We have all these ideas about finance, but we need to talk to the master. And at that time, Bob was already a superstar in finance, having extended the Black-Scholes theorem and also having basically converted the ICAP-M from a single period model to a continuous time finance and figured out all the implications of that. So, but that's not why we're giving him the award tonight. It's for his more recent work, and so let me just say that Bob has focused on many different problems in his career, and most recently focusing on the problems of retirement and customizing portfolios not just to the age of an individual, but also their personal circumstances. A very important thing to do, and something that certainly the current technologies will take advantage of, I'm sure, and probably very much transform the investment management industry. So that's really why we're giving Bob that award. Now let me just quickly go through some of the highlights of Bob's biography. Bob Merton is the School of Management Distinguished Professor of Finance at the MIT Sloan School of Management and the University Professor Emeritus at Harvard University. He's currently resident scientist at Dimensional Fund Advisors, where he's developing a next-generation integrated pension management solution system that addresses the deficiencies associated with traditional defined benefit and defined contribution plans. Bob received the Alfred Nobel Memorial Prize in Economic Sciences in 1997 for a new method to determine the value of derivatives. His research focuses on finance theory, including life cycle finance, optimal intertemporal portfolio selection, capital asset pricing, pricing of options, risky corporate debt, loan guarantees, and other complex derivative securities. He's also written on the operation and regulation of financial institutions. His current academic interests include financial innovation and the dynamics of institutional change, controlling the propagation of macro financial risk, and improving the methods of measuring and managing sovereign risk. Bob holds a BS in Engineering Mathematics from Columbia University, an MS in Applied Mathematics from the California Institute of Technology, and a PhD in Economics from MIT. Please join me in welcoming Bob tonight.
Well, thank you. Thank you. I was just looking around the room, and I like it here, but that reminds me of, not Fenway Park, but it reminds me of Ebbets Field in Brooklyn, the Dodgers, where I always got a great seat, except it had a pole in front of me, and I couldn't see what was going on. So some things never change. But anyway, I wanted to, first of all, to thank my colleagues here at MIT for having given me this recognition and made me as a lecturer for this year. It's a great honor to have your peers and colleagues do such a thing. And then, of course, I'd like to thank Donald for having created this award to be given. Very generous. I thank all of you for coming. You have many things you could be doing. Now, I notice there's some students here, so I have to take a second, if you'll wait. 2 and 2 equals 4 is my answer in class and here. So if you hear things that I told you in class here, I'm not going to change it for variety's sake. 2 and 2 is 5, so you can get excited. Okay, enough. Now I've made full disclosure. Well, let me get started here. First of all, on the slides, I'm not a slide person. In fact, I'm a story person, and I'm going to tell you stories tonight. But I do have slides, partly because that's required, but more functionally, well, you know how it is, but more functionally, it's the idea if you hear anything tonight that you find interesting, we're going to post, they're doing a video of this, we're going to post the PDF of the slides so you can have your own copy and you don't have to take notes, okay? But as you will see very rapidly, with the exception of a few slides that are kind of nice, which someone else did for me, a good friend, and the other ones are crowded, and they're terrible if you actually had to look at them. So that's my second disclaimer. All right, well, you ready to get going? Now, let me talk to you a little bit about the lecture. You've seen the title, the impact of the observations on the role of finance science and innovation on growth and economic development. And if you kind of look at this picture, the foundation of what I'm talking about is the economy, growth and development. The second one, the role of science and innovation. Now, this is a 3-lecture series, and we're taking attendance to see how many come to the second and third. Now, of course, I was told that if not too many people sign up, we may have a contraction of the usual 3 lectures into 1. But I've taken it as 3 lectures, and that's important because the overall subject is all 3. And then I've chosen to put it into 3 parts. For the first one tonight will be sort of in intangible derivative contracts, solving tangible problems. I'll make it a little clearer. I just like to use this. But I'm going to be talking about derivatives as a solution. The second one will be, next time, will be devoted entirely to addressing a major problem that was alluded to here, which is designing designing a solution for the global challenge of funding retirement. And how do you go about doing it? And I figured that would fill a whole lecture at least. So that's the second one, all in the spirit of this. And then the third one will be based on the replication principle in portfolio theory and a sort of potpourri of uses of that in the production of financial securities. This is the first one. I'm going to put them all up, okay? You can read those a little better if you can read them at all. But let me say something about it. This is actually, though, personal. It's all about the same subject. And I hope that there's something here that you find interesting. But what's personal about it is the first one involves derivatives, something that I've been doing all my life and using them for solutions. The second one, as you heard, is something I've been working on with others. I see Svibodi is here. I have to look around the rest of the audience. Sorry if I miss you. On addressing this really big problem. So, of course, I want to talk about that. And then the last one, using the dynamic portfolio replication principle, that's a mouthful. That's essentially came from the work that I did on developing, when I was a kid, on dynamics of portfolios, how you would model portfolio dynamics, sample path by sample path, not by expectations. And it turned out that that technology had a lot of uses in finance, and one of them was the contribution that I made for which I shared the Nobel Prize. Namely, I was able to show how you could produce options as a replicating process, as a production process. So when I talk about using that now, you see now it's a very personal event, even though it's covering all of these. I'm not doing this all tonight. This is a teaser for those of you, or at least a disclosure. Okay, so let's get to tonight's lecture. And it's on the use of intangible derivative securities from Wall Street to address very tangible challenges from Main Street in the economy. And all three of these lectures are predicated on finance science and financial innovation. And so I'm doing, first, before I get into tonight's subject matter, I want to say a few words about what is background for all of these. The first is to remind us that a well-functioning financial system is critical to economic growth and development. I know we sometimes hear about the real sector and the financial sector as if they were a dichotomy. That only exists in some old textbooks, in my view. They're inexorably linked. They're both real. They both have impact. Bob Solow, when he developed his growth theory, he showed us that growth in an economy was driven much more by technological progress than the traditional belief of population growth or frugality and saving. And there's a lot of technology being created on this campus and in its environs. However, if it just stays in the MIT labs and does not permeate deeply and widely into the economy, you will never see the growth and development as a consequence of that technology. And what gets it from here to there very much involves a well-functioning financial system. And I know you're aware of it. Now, the second thing is I talk about finance science, and so I thought I'd say a word or two about finance being a science. I'm not going to get into that debate. I don't think we need to. At least my rendition of it is prior to 1950, I don't think you could claim it as science. Finance, in terms of an intellectual thing, was a collection of anecdotes, rules of thumb, accounting identities. There were no big data sets at all. There was no data really to look at. This is not saying anything wrong about the profession. It just wasn't science. I believe in the 1950s, it started, this is my list for the 50s, Markowitz, Ken Arrow, Jim Tobin, Modiano and Miller. The CRISP study done at the University of Chicago was the first time big database was created going back to 1926 with all the stocks. And the first peek at the data, I'm not going to get into each of these. Did anybody remember what they did, after you created all this data? It's a lot of work. Anyone who's ever done that knows that. They asked themselves, if you took all the stocks and just asked, what would an average stock, you just buy one stock, what would an average stock have earned through the roaring 20s, the depressions, all the way through to the 60s, okay? Anybody know the answer? I know there are people, they're being polite. I can see them in the audience. 9.3 or 9.4%. I confess I don't remember for sure which. That was the biggest shock to hit from the data. Nobody in any trust department had ever created 9.3 or 9.4% returns for their clients, on a regular basis. That was an eye-opener. Then we had, perhaps influenced by the data, but certainly influenced by data, Gene Fama and Paul Samuelson with their efficient markets hypothesis, which might explain why it was hard for those trust departments to do it. And then, in fairness to the trust departments, then came along the capital asset price model, Bill Sharp's and Lintner and Mosin's contribution, because it was a little unfair to those trust departments to take an average stock. Why? Because the average stock probably in our vernacular had a beta greater than 1, and so it probably had a higher expected return than the typical trust department because it was more risky. The CAPM took care of that because he says not all stocks just picked will have the same expected return, but some will have higher than other, and that's because of risk. And it gave us a way to differentiate risk. And therefore, when we checked for the trust departments, sometimes they didn't have as high an average return, but they took less risk to get. So final point in this, and then I move on, is all of this created a wave of testing of performance and so forth. Well, by the 50s and into the 60s, all I would say here, you have well-developed theories, well-developed hypotheses, structured, et cetera. You had important and big databases corrected, and you had people going about in a rigorous fashion developing and testing hypotheses. So I think that qualifies as a science, at least as far as I know. And I looked it up. Depending how you count it, first of all, you could tell from this list alone, there are between 10 or 12 Nobel laureates in economics who did work, or their main work was done in finance. Okay, so I guess that's enough. I'm not going to debate it anymore. Let's move on. Okay, now, the second part that I want to point out, it's distinctive about finance, and it's connected here by my title, is the inexorable connection between high-level, top, leading, cutting-edge research in finance and finance practice in the mainstream. I think you would, if you were to do a study, you would find it's very rare. In fact, I don't know of any other of the social sciences, including, I will say, every other branch of economics, I'm sure somebody will tell me one, that has had as close a connection between the cutting-edge research, both theory, modeling, and empirical work, and mainstream practice, as you have found in finance. And what I wanted to do, a part of other things tonight, is to say a little bit, how did that happen? When? And why? And that leads me to the 1970s. And I'm going to take you in a fast pace here. I have several agendas for this, besides the one I just said. And I want to remind you now, please, I'm not going to be like those two comedians that get up, and the one says, well, I had a dirt floor when I was growing up, and the other one looks and says, of course you had a dirt floor, but at least you had a roof. They're each trying to outdo each other. I'm not going to try to outdo you on whose crisis was bigger. But I've always found it a bit of a mystery why, with the 2008-2009 crisis, which everyone here is familiar with, it's always compared to the Great Depression. And although, yes, it may have been the second highest or lowest, how you want to do, unemployment after there, but those other things I don't see as being very close. I do see the 1970s, in my view, at least when it comes to finance and the financial system, as a much closer analogy. But again, I'm just telling you my motivation. Now, let me remind you, without explaining it, what happened in the 1970s, okay, in the United States, because the United States is fairly important. So when it happens in the United States, it's happening everywhere, okay? We had a multidimensional explosion of volatilities that hit. The first one, in no particular order, is the fall of Bretton Woods. You may recall we had exchange rates were all wired up since 1944 or sometime around the end of World War II. We didn't have to think about exchange rates. They were always the same. Suddenly, they were all floating and jumping around. That's a big shock. Nobody had been dealing with that for a generation. So there wasn't a lot of immediate practice with that. What else happened? The first oil crisis, we didn't know we had to number them, where oil went from $2.50 a barrel to $14 a barrel, $13, $14 a barrel, okay? And needless to say, that was a pretty big one. What else did we have? Double-digit inflation. Now, it's hard for you to believe, I'm sure, unless you were there, but we had double-digit inflation in the United States, and we hadn't seen that since the mid-19th century, the Civil War in the United States. That was 100 years earlier, meaning there was nobody around who had any experience in this country with double-digit inflation. What else do we have, not surprisingly, with that level of inflation? Double-digit interest rates, and for the same reason, we hadn't seen those in the United States. Later on, they were at a peak, the shorter end anyway, peaked at over 20%. Can you imagine interest rates on governments at 20%? All right? So that's a kind of big shock, and shock in the sense we had very little experience, or those who were around. There was no mortgage money, period. You could have two fabulous, qualified people, wife and husband, both MDs at MGH, and all the rest, good health, everything else. Well, they couldn't get a mortgage. Why? You don't need rocket science. If U.S. governments, long-term and short-term, are paying you over 10% and give you a tax break on your Massachusetts tax, and if you have a law, a rule that says, Reg Q, that banks can't pay more than 5%, how much money do you think people are going to put in the bank? And that's what happened. So there was no mortgage money. What else happened? Well, now we get to the interesting part. Remember the high inflation, 10%? I hadn't seen that. We had high unemployment. Now, we didn't have that this time. We had high unemployment. We had a lot of shocks around, but we had no inflation. Imagine 9% unemployment. So it's slightly lower than the peak this time. That's a lot of unemployment. And what did we discover? We had a really big problem on our hand because the standard tools for the Fed or for fiscal policy to address high unemployment would be seen as putting gasoline on a fire for double-digit inflation and vice versa. And so it was this real stranglehold, and we named it, or someone named it, not I, stagflation. I just asked, I won't tell you which macroeconomist, but certainly someone I have a great deal of respect for, do we know what to do if stagflation comes back after 40 years? And the answer I got, at least from that one, is no. So let's just hope it doesn't come back. The stock market fell 50% in 18 months in real terms. So that's a fair number of shocks in the financial system, okay? Now, what was the response? The response in 2008, 2009, as it relates to financial innovation, which is in the title here, was what? Pull horns in, stop all financial innovation, shut down all these things that are called new, even though they weren't new, but shut them all down, and be very, very careful and don't do anything. In fact, go back to doing almost nothing and put lots of things on it. Now, maybe that's the right prescription. Don't hear in my voice I say I think they did the wrong thing. I'm not going to give you a judgment on that. But I want to point out to you that's not always what happens. That's not the norm necessarily. What happened in 1970 when this happened, we had quite the contrary. We had an enormous explosion in financial innovation. So just quickly, because otherwise we won't even get beyond the predicate, we created an option market for the first time. That's an insurance market. What else? Financial futures for currencies, which are now fluctuating. Interest rates, by the way, if interest rates are fluctuating around double digits and as high as 20 at one point, do you understand why people might find that that's a little bit discomforting if you're trying to finance a 6-year real estate deal or you're trying to do a mortgage or whatever? And so there was a lot of risk from interest rate stocks. We created electronic stock markets, the money market, index funds. Well, if I get into all of these things out there, we created index fund. Paul Samuelson was on trustee of CREF, TIA CREF. You all know who that is, the big insurance company for professors. He pushed, along I think with Bill Sharp, to have CREF, which had only one equity portfolio for everyone, no choice, to have international diversification as a core part of the strategy all the time. As far as I know, that may be the first time that a major institution in the United States actually went into doing it, but if you have others for me, tell me. It certainly was a big event. We redid the pension system for the corporate pension system. Mayday, negotiated commissions, that opened the door to the institutionalization of finance, which has been going on now for decades. You probably can't even see it down here, but globalization, the foundations for that, certainly the derivative markets were adopted around the world, and that global diversification, and importantly, finance science. The science I showed you up to the end of the 60s really took off, really in 1969, 70, to a whole new level. And what happened is a whole bunch of new theories for dealing with, among other things, in my part of the world, things like how do you price an option? If you're going to have an option market, you have to know how to do it. If you're going to have insurance markets, you have to price them and know their risk. All that research happened at the same time and was delivered. Now, that's why I always think it's better to be lucky than smart. If we had done the same work in 1960, it might have gotten published. It wouldn't have had any impact on anybody. But we did this work on options and solved this thing precisely at the time it was needed to do these innovations. And from theory, out of our heads, mathematically, thinking about it, not to being used everywhere in practice, a total of 2 years, okay? I mean, it was being used everywhere. Not because of intellectual curiosity, because of need. All right, so, and that's not just what we did in options. The same thing was true in portfolio theory. The same thing was true. We needed all these powerful tools to handle all these markets in an environment that was very, very risky and new. I'll close on this to remind you, look at that list. They're all today things that all of us use and take for granted. Index funds, you can get a mortgage anytime. We created a national mortgage market. We've never had no mortgage money in the 40 years since that happened. We just take that for granted. That wasn't always the way things are. And you don't do that with two markets, a bond and a stock market, and a bank. Okay? This is the real world. So finance science played a critical role in the huge innovation. But just as the science influenced innovation, innovation influenced the science because it created lights in the parking lot to look for the lost keys of things to work on, data and need. And so it was a very, very productive, in my view, feedback. And that's where the inexorable connection, in my view, started and came, and it's been going on for 80 years. Okay, enough of that. Now I've established the principles. Let's get to tonight's lecture, the intangible derivative contracts to solve tangible problems. And I make the statement that derivative contracts can redistribute risks to those who are better equipped to bear them in a non-invasive and reversible way. Those are two properties that are very useful. They're useful, of course, for the obvious reasons of doing them, but they're also useful because if people know something can be reversed, they're more likely to do it than if you tell them they can't be reversed. You're walking through a door, you can't come back. So there's much deeper results there than just the manifest ones that there, but even getting things done. And what I'm going to do is take some examples to tell you stories and show you what kinds of things are done and how they do. I think they're timeless examples. They come, like I've given you the 1970s to show you how this thing. I'm now going to move to the 80s, 90s, and so forth. But I want you to understand it doesn't matter when they took place. They're just as relevant today. They are used today. And they help you to understand how we address problems today. So the first one I want to talk about is eliminating the largest risk that was in banks forever. Not a bad deal. What was the largest risk in well-run banks performing pretty standard banking services as we understand them in the United States for the moment? Borrowing, lending money to entities, and what else? Providing deposits. That's a pretty standard kind of thing. So what happens in that nice Jimmy Stewart type traditional bank? Very simple. They have two customers. borrowers, and of course, going through all these interest rates I just showed you, you would understand that if you're doing projects or why you might want to have fixed rates. You can go bankrupt if the rates were to move against you in the way they did. So it's not unreasonable for them to have tastes to hold fixed rates. Okay? That's what the customer wanted. But what about the depositors? They wanted to get their money at par anytime they want. So the only way you could do that is you have to give them floating rates. You can't give them a fixed rate and let them get their money whenever they want it at par, right? So by filling the role of these two customers, doing the job that banks are supposed to do, set up a huge problem for the bank. Because how does the bank operate? The bank gets paid by the borrowers a fixed rate, finances that with the deposits from the people that are lending to the bank, the depositors, except the rate you pay them is whatever the market rate is. So if the fixed rate is 6% and you're paying them 5%, you're okay. Well, what if rates go to 10%? You're still only getting paid at 6 because you remember the bank doesn't get to change the borrower's rate. You go bankrupt, you go insolvent. In fact, banks all the time were going insolvent. They didn't go bankrupt because the government would step in with some versions of forbearance in the belief or hope that things will come back. But if you take a look at it, that risk in a bank was far larger than credit risk, which is one of the things that banks are supposed to do. What changed that? A simple idea contract, the swap. And most of you, probably many of you, will know what a swap is. In case you don't, it's so simple. I shouldn't put it that way, because then if you don't see it, you'll think there's something wrong. Look, what it just says is, I have a contract. I'm going to have it with him, okay? And I'm a bank, and he's somebody else, not a bank, okay? And what I say to him, on a certain amount of money that we'll talk about, a notional amount it's called, I want him to pay me a floating rate, whatever, let's say, U.S. Treasuries are, some other reference floating rates. You all understand that. You see them every day, right? So we're going to look at whatever rate is today, multiply that money. He pays me that. What do I pay him? I pay him a fixed amount on that same amount of money. So if it's on $10 million, he pays me whatever the interest rate is. I pay him 4.9%. Fixed for the next 10 years. Everybody understand? And all we're doing is swapping on the same amount of money, different returns. So the price of the value of the swap is zero. I don't pay him anything, he doesn't pay me. We're just swapping. That's hence the term. Everybody okay with that? Okay. Pretty simple to understand. Now, I'll put it in very direct. Very hard to execute creating that instrument on the scale and efficiency needed to have it work well. So it's an example that the idea is simple to understand. Implementation is very difficult. But let me just show you what happens once the bank can enter into a swap, which remember, they don't have to pay for. What happens is now, before, the bank was getting, there it is. The bank was doing this. The bank earnings where they got a fixed rate, they made it a floating, and we see they were at risk for interest rates going up. And they could go bankrupt. But now they pay a fixed rate, and they receive a floating rate. They're still satisfying both customers' needs. Notice their customers are doing what the customers always did. So there's nothing disruptive or invasive to fix this problem for the banks with the customers. That's important to see. We can fix it easily. We can tell customers, sorry, you can't borrow fixed. You have to take floating. That's not what you want, but that's what you're going to have to do. Help the bank. That's not a good model, I don't think. So what this contract, this simple contract did, left the bank, basically, as you see, it had the difference of the two fixed rates, what its customers pay it for borrowing, and what I have to pay to him, which is less. And then I get the floating rate from him, and I pay my customers on deposits, which is less than I'm getting from him. And those two spreads are my compensation for providing the banking services. And you notice, I don't care what happens to interest rates now. So what we have done is, actually, interest rate risk is no longer a banking service risk. Now, I know all of you are sitting here and saying, yeah, I know this. This is an old deal. Yeah, from the 1980s it was done. But look, stop for a minute. That simple contract eliminated for every freaking bank around in their core providing services to customers that customers wanted. They took the largest risk was there, and it was particularly nice because it was a risk that you don't need to be a banker. It's terrible when your biggest risk is not even connected to your business. You know, some businesses you have to take risks to do the business. This is one you don't need to take. Today, you all know, if interest rates go up, you really can't predict whether JP Morgan, Bank of America, Barclays will do better or worse, because they can use this swap to move interest rate exposures to be anything they want, no matter what their book looks like for their customers. So I just want to remind you, so that's what it looked like before, and that's what it looks like afterwards in terms of variation. I can't resist. I hope you don't mind. We're among friends here, right? There's no... Oh. Did anybody remember a certain former central bank governor making a statement of something about there hasn't been a useful financial innovation for society since the ATM? If you haven't, just imagine one did. Doesn't matter who it was. Does anybody know when the ATM was invented? By the way, the ATM is not a financial innovation. I mean, it's a processing tool, right? I mean, go to the bank, you'll see. It's ka-ching, ka-ching. It has nothing to do with finance principles. But let that go by. Anybody know? 1969. Therefore, I ask you to think about it. I want to move on. Everything that was on that list I showed you was done in the 1970s and after. So the mortgage market, all these things, and the thing that took the biggest risk out of all the banks around the world doing their job. Okay? I'll let you contemplate that one. All right. So that was my first story. And I wanted to do it even as simple as because of the profound impact that that has had. We've forgotten. But we were able to take a lot of capital requirements and costs out of banks because we suddenly brought their risk way down. Okay? So that's real. My second one comes from, my second approach, for, sort of story, is about more efficient solutions for the real world, also for a greener world. You see how it's kind of timeless? The swap came from the 1980s. That's a long time ago, but it's newer than the 70s. I'm now up to the 1990s, okay? And in the 1990s, when Germany reunified in the early 90s, the East Germans and the West Germans came together, and of course the economics of the East Germans was very different than the West Germans. And one of the things that Germany wanted to do as a country was to bring East Germany up so that they were comparable. You didn't have a big thing. So there was big incentives for East German cities in particular to grow. They wanted them to grow. They would have grown anyway, but to really get them to grow. So the city of Leipzig wanted to grow. It needed a lot more electricity because you need electricity to run things. And the way power plants worked, it used natural gas. So they went out and said, now remember who the managers of Leipzig would be. These are people that have managed the city under a command and control economy. They haven't looked at a price change. No prices changed. It was a different kind of economy. So these were not very financially sophisticated people. They didn't have to be, all right? Now, what they wanted to do is get the gas, and they got two proposals. One came from the Russians saying, we're a consortium, we'll give you 15 years of gas. We'll supply gas to you 15 years in Leipzig at a fixed price. So many Deutschmarks, just before the euro. X Deutschmarks per MCF. Did everybody say, all right, 15 years, pretty simple. And they kind of like that because it's a fixed price, so you won't have a lot of price fluctuation, right? So that sounded good, maybe. The alternative was to take your gas from the West, the North Sea and so forth. But the price fluctuates, as you know, as you see it today, moves with markets up and down, sort of like that floating rate event. And the thought of people getting bills for generation, not seeing any price change, getting those bills doing this every month was pretty unpalatable. They realized, of course, the political problem, even with the fixed one. California, those of you who remember when California had a similar thing, if you go into a fixed rate contract at X Deutschmarks per MCF, it's fixed, right? Looks pretty good. What happens when the open market is half the price that you're paying? How do you explain to, say, 40 million Californians why the government is paying twice the price for electricity, or why Leipzig would be paying twice the price for gas when the market's there? We all understand that, but it's not an easy thing to explain in a 30-second soundbite. So both of them had problems. So I would say that's like the proverbial question, which would you rather do, burn to death or freeze to death? My response to that is always, is there an option 3? Okay, and it turned out there was an option 3, and I'll just very quickly describe it. A bank heard about this dilemma, and it came up with a solution. A bank, not a pipeline company or, oh, I forgot to mention, the Russian solution required that a pipeline be built all the way from the east to far east into Leipzig. $300 million. Now, I know it doesn't sound big. Put another zero on it if you want, okay? $300 million. A little pipeline was needed to bring it from the west, 50 million. So that's one piece of important information, okay? Now, you know the Russian price that they quoted has to cover their costs, including the pipelines. Keep that in mind. What did the bank come up with? Had to be simple. Now, you think of you're the city manager of Leipzig for a moment. Did I bring in a team of people with net present values and, you know, a bunch of simulation? No. They came in and said, here's the deal for you. Physically take your gas from the west. Choose option 1. So do that. Enter in a contract with us in which we, the bank, will do the following. Anytime you pay more than X Deutschmarks per MCF for gas, we'll refund to you the difference between what you paid and X. And if you pay less than X, lucky you. Is that a hard decision for you? Which do you pay? X all the time, or no more than X and sometimes less than X? Now, I point that out to you because a little footnote here. You've heard all the time people say, there's too much complexity in finance. We meant to simplify, simplify. That's good. No one wants to have excess complexity. However, the problem is that most of the time, the way we simplify things is simplify it for the producer, which typically makes it more complicated for the consumer. So the bank has a problem with floating rates. It tells consumers, you take a floating rate mortgage, even though you're going to take the risk, okay? So if you look around, I'll paraphrase, you know, the Einstein thing, right? You know, simplify as much, but no more than is needed. And that's the case here. And if you are going to have complexity, my view is it belongs with the producer. Consumers should be simple. Was that a nice, simple deal for the consumer? You all made your decision pretty quickly. You didn't even have any PowerPoints other than this one, okay? I can tell you it was really simple for the managers, very complex for the bank. The banks were taking currency risks because the West is in dollars. This was Deutschmarks. It was writing what's called a cap, which is an option, which means the volatility of every market they're involved in was also a risk as well as the levels, okay? They didn't have a natural gas market to hedge. They hedged with heating oil, so they had to take all kinds of basis risks. And the maturity of the contracts were at most sometimes 5 years, nothing, and this is a 15-year contract. Well, I won't get any more hung up on this. Let's just say it's a lot of complexity. But that's what this bank's job was to deal with all that complexity, execute it well, give a good deal to the client, and make money. Because if you don't make money, you don't stay in business. So difficult, yes. Those from MIT, you love difficult, right? If everybody was simple, who would hire you? You've got all this horsepower and this knowledge, this creativity. You're not needed. Well, don't worry about it. But I just want to remind you, there's a lot of complexity, but that's where it belongs. By the way, if somebody thinks it was some play on credit, this bank was a far better credit than Russia. So it wasn't a credit play that got them there. Now, how did the bank give a better deal to Leipzig than the Russians? That's what you should be asking. If it looks too good to be true, it's probably not true. And, you know, there's no free lunch. The bank had to get paid. How were they able to give a bid? Would the Russians highball it or something? No. What happened here is because they chose physically option one to take their gas from the West, there was a $50 million pipeline, a little one. Had they chosen the Russians to get that nice stable fixed rate, they had to build a $300 million pipeline. That means there was $250 million on the table if you could do number one and satisfy the need of the customer, the difference of the cost of the two pipelines. And in fact, the way it worked out roughly is that 125 million went to the city and 125 million to the bank. The bank didn't make 125 because it took all kinds of risks and everything else and had to do everything. As I say, it's very complicated. But that's the logic. So that's where it came from. And this was purely done by contracts with the bank, hedging and doing so forth. There were no physicals at all. So here's something totally intangible, a bunch of physical contracts. Okay, today they'd be zeros and ones on a machine, okay? And by just reorganizing things and looking at the problem and using these tools, you ended up saving $250 million or getting $125 million to the client that what the city could use. But the punchline to this 1990s stories is what else? You didn't build a big, dirty, nasty pipeline. Even people who build pipelines agree that they're not, they're a problem environmentally. So it's green. It was a green solution. It not only saved money, gave them to it, but it also was very green. That's why I picked it to show you. Even back in the 90s. So we're not talking about in 2017, even though it's a 2017 story, sustainability. Okay, so let me move on to a sister event so you don't think this is the one case in the last 30 years that I dug up. TVA, which is, as you're probably aware, was created in the 30s, is a huge power generator in the United States. It was created in the 1930s. In 1994, when this event took place, it was the largest public power utility in the United States. Today, it still produces something like 3.5% of all the electricity produced in the United States, one company. It's one of the still largest, maybe the largest. And it was looking at ways, thinking strategically forward of how to expand capacity. Am I running out of time? I should look at I have this terrible feeling. Yeah, well, we've got some time left. Okay, well, I think we'll be all right. Sorry. You ever have that feeling like everybody's being polite? But geez, it was supposed to be over a half hour ago. Where's the window? Anyway, so to go back to here, so what they were doing is looking forward like you would a big entity, because power things have long horizons. You don't just build a power plant overnight. And they were looking all the way to the 21st century, and they were trying to think strategically about expansion of their capacity to produce electricity. And a proposal was put to them. They were looking for various so-called robust supply channels, channels they could rely on longer term to be able to provide energy. And they had physically done nuclear, they had done all kinds, hydro, So it was a robust set of channels they've been looking at. And a proposal was given to them, an innovative proposal, to adopt as one of the channels to meet the capacity by using derivative securities contracts, just as in the case of Leipzig, as a substitute for building a power plant. In the previous example, in effect, we created a synthetic pipeline. We got the fixed rate at better for the client as if they had built that $300 million long, nasty pipeline, but we didn't build it. So hence, we synthesized the functionality of the pipeline without building it. So we got the functionality without the building of it. Okay, so what happened here is the proposal was they just took what we would call calls and puts. They called them option purchase agreements, that's fine. And they went out to all the entities who had a connection to the grid. They could deliver actual electricity to the grid. We know somebody, a friend of mine out in the audience knows somebody who has a beautiful vineyard. And he's a smart guy, and he does lots of things. And everything is sort of not only super organic, but super conservative. So he has solar panels, it's all self-contained. He has all these solar panels, and he found out he's producing more electricity and needs to run his whole vineyard. So he's now a supplier of electricity. He produces electricity. Now, admittedly, not very big, but all around the country, these sort of what we call mom and pop, mom and pop type systems, not just big systems, that can supply to the grid. And they're big and they're little and all kinds of things. So they went out with these contracts and they said, anybody who delivers to the grid, and they had some other conditions, but basically if you can deliver into the grid. So no finance firms are just going to do the contracts. You had to physically deliver, and in order to qualify to buy these things, you actually had to be plugged into the grid. So you could actually deliver electricity. And they sold calls and they bought calls and sold puts, so the TVA was buying production so that they could call on the thing if they needed it. Remember, it's an option. So if it turned out there wasn't that much need, technology, they didn't have to do it. But if they needed it, they could turn it on. Now, there's short-term training done in energy markets to get capacity. This was long-term. These were long-term contracts to try to build a stable base. It was very different in that respect. And they did it. Now, the punchline was they did enough of it so they did not build 2 nuclear power plants. It's like some of the Sherlock Holmes stories. After Sherlock shows you how stupid you were, you didn't see it. I think The Hounds of the Baskervilles was one, where the thing was not what happened, it was what didn't happen. The dog didn't bark or something like that, okay? Well, here, the payoff was 2 nuclear power plants were not built. That's the equivalent in terms of production of 35 conventional power plants, I'm told. Don't take my word on it, that's just what I was told. But 2 nuclear power plants you can understand. All by doing what? Reorganizing the existing resources in the system, because these are all entities that exist. But the markets, using these contracts, allowed a way to organize getting all these people coordinated to provide what they wanted. They created a synthetic power plant. So we had a synthetic pipeline, or we had a synthetic power plant. And again, green. So that's the end of my second story for tonight, okay? So first one was biggest risk in banks, gone forever. Not bad, I think. Second, doing things more efficiently. Leipzig got 125 million out. That's good enough, right? If you're the city manager, you're smiling. But then on top of that, you also made it green. So now let's go and see where this next story comes from. Now, you've been very good. I've been watching you. 1970s. Now, for someone who was there, that doesn't seem that long ago. But I see people here in the front row who I'm related to who weren't there. And I see many of you out there. And then I got you to the 80s, and then just finished in the 90s. I'm not going to go each month because I don't have enough time. I'm going to 2017 today. And let's talk about challenges that exist in the real economy today. Now, I've took you in the United States banking. I took you to Germany. Then we came back to the United States with TVA. And now I'm taking you to China in 2017. And the issue that I want to point out in China, it's a big issue, okay? Not exclusively in China, but China's big enough. It's a good example, okay? And it's pretty big in China. Has to do with events that most recently for China, or most dramatically, was when their stock market in the latter part of 2015 just went, and those in power got very, very scared. I am told, in terms of priority, China has a high priority for growth. But I'm also told in China they have an even higher priority for stability. And so if they have to trade off stability versus growth, stability apparently is the winner. And so decisions were made, they've been exactly the right decision, to say we have to kind of stabilize. They put all kinds of controls on, exactly at a whole level. And furthermore, this had been going on for some time. They really upped, and you read it in the newspapers today, that they put on capital controls. In effect, you can't take your money out of China and invest it outside of China. That was even restricted before, but now, okay. And of course, therefore, you can't put your money in. And of course, you probably wouldn't want to put your money in if you can't take it out, right? So even if you could, but you can't. So capital controls were put on with the idea, the fear, and maybe legitimate. I'm not going to debate the virtues or not of capital controls, that if money's going to be pulled out all over the place and pulled in all over the place, that could be disruptive. If you decide it's worth it, I'm not debating that. However, there's a cost to that benefit. And I want to show first the cost. And the cost I can illustrate here with a little graph that I did. I used some data for the last 25 years. This is a lazy professor. Why did I start in 1993? One of my colleagues had a data set that started in 1993. So I said, that sounds good, because I'm not trying to show you these numbers to prove a theorem. I'm using real-world numbers to tell you a concept. But it's more interesting if you real numbers rather than if I put a bunch of equations on the board. So I ran the data, and I asked the question, what did the stock market, the world stock market, the best diversified stock market, the best diversified risk, diversification is a good idea. You all have heard that by now. Every one of you would have 401k. They tell you diversify, diversify, right? Right? Okay, so I'm assuming everybody understands that's a good thing. And it is. It's very powerful. The best diversified portfolio in theory is the market portfolio that holds all the assets in the world, at least until we go to Mars or Venus, in proportion to their value. So that's what we mean by the market portfolio. So in the direction of diversification, that's the gold standard. Okay? What we plot here along this axis is risk. Doesn't matter. It's a standard deviation of the return, but it doesn't matter. You don't just call that risk, how much risk you're taking. And on the ordinate is how much average return you get. So risk, average return, and those lines tell you the menu of risk returns you can get by holding different types of risk assets. So the red one is what the risk return you would have gotten in this period, the trade-off. So if you're very risk averse, you'd be way down there with low risk. If you're a gunslinger, you'd be way up. But that whole menu can be seen by this red line. Does everybody understand? It's like a menu in a restaurant. You want something very risky, up here. You want something lower risk. Here's what you get for it. Okay? I love that creamy potatoes and everything. Then I look at the calorie count. This is calorie count. That's taste meter or something, okay? Do you understand? Got it? And that red line is your menu, what you can get if you take the best diversified portfolio, the world portfolio. The green line is what you should have expected to get. I said should have expected to get from China if you only invested in China. You did not diversify around the world, but only held China. Okay? What do you see about the green line? It is flatter than the red line. What does that tell you? At least in this period, by only holding China, for the amount of risk you took, you gave up return. So any one of these risks, that's the expected return you get from China. For the same risk, that's the expected you get from world. Does everybody know how to read it? So you see, steep is good, flatter's bad. Now, why I use this is, the blue one, that's what actually happened if you invested in China. It did much worse than expected, but that's not part of the discussion. I just thought, in case you wanted to know what actually happens if you you did worse than expected. But that's bad luck. What I'm trying to point out to you is this is a measure, for any risk, this difference is a measure of the cost of effectively saying for the economy, for your investors in China, if you were representing China, the risk, the cost that's put on your institutions, your financial institutions, and your individuals by not letting them invest outside of China. Now, there are many other things, but this is a big macro cost. Okay? Now, how big actually the cost to China would depend on a lot of other calculations, because you'd have to say, how much risk did China really take and all this. I'll give you a ballpark number, which is no more accurate than the rest of these numbers, because I'm only trying to show you the idea. 3% a year. Now, to frame that for you, you say, hey, what's 3% among people, you know? If you're NCSSF, which is now the pension for 1.434 billion people, that's their national pension thing. The provinces have all give their money to the center, okay? An extra 3%, I've noticed someone in the room knows the rule of 72. If you don't have a calculator or all your batteries are dead and someone asks you, how long will it take me to double my money at some interest rate? Just divide the interest rate into 72 and it'll give you a pretty good approximation. 6%, 12 years, 8%, 9 years. Get it? Remember that. If you got nothing else out of this lecture, when the lights all go out and everybody says, I don't know what to do, we need to know what it takes to double how much time. Okay, so if 3% goes into 72, 24 years, that means an extra 3%, you would have twice as much in 24 years. Now, if you're a pension, in less than one generation, you'd have twice as many assets. That's a big number, and that's the only reason I'm showing you this. First thing you have to establish is the cost is large. If the cost is small to a decision, then why bother? This is very large. Now, the precise number, don't worry about it. So first, you show it's a bad cost. I see, we're going to get, you know, that rope. All right? So, but if you just go and say, you've got a problem. You're doing this. It's costing you a lot. That usually gets you in trouble if you're junior. And if you're senior, they'll listen to you but not do anything. If you go and say, you've got a problem, see this cost, and I have a solution, and it's not you stop what you're doing, because that never works, because they want to do it. They feel they have to. Remember, stability is more important than economics. That's the predicate here. What I said is, you look familiar. How about we do the following thing? You have your pension fund or your sovereign wealth funds, your individuals, everybody, only hold Chinese, I'll just do it with the stock market, Chinese A shares. Those are the local shares in China. So they only invest China. And their money is all invested in China. That's what they want with capital controls, right? They don't want it flowing out, and nothing is going to flow in. Okay? So that is the objective. I'm not saying it's a good policy, but that's what they want it for. What if we then had this sovereign wealth fund or the pension go to another entity, for example, the Norges Bank, which is the sovereign wealth fund of Norway for the future of the generations of Norway, or in Finland, and you know, you don't have any money. Well, okay. So we'll stick with Norges Bank at 900 billion. Okay. Now, you go to them and say, let's enter into a swap. It's a total return swap. It's not an interest rate swap. It's a total return. Same idea, though. And here's what we're going to do. China's sovereign wealth funds or pensions is going to pay the total return on Chinese A stocks to Norges Bank, applied to any number of billions you want. You understand? So you take $10 billion, whatever happens to Chinese stocks, you multiply that number times 10 billion, you give it to Norges Bank. In return, we look at what the world portfolio did, whatever return it has, multiply $10 billion, and Norges Bank pays that to the China bank, to the sovereign wealth fund. Do you see the transaction? All right, what's the economics of that? Before it was done, you had the concentrated risk I showed you. Remember the thing with the 3% per year cost? Now what do you have? In terms of risk, your returns are the world stock market portfolio. You're physically owning Chinese A stocks. You're physically voting, so you have the governance control. The cash invested in Chinese companies, any Chinese putting cash into the stock market, new issues, that cash is going into Chinese companies. So you're satisfying governance. You know, people like the idea that their governance is people running in control of their companies are under some kind of jurisdiction of the government. Second, so that's the voting, right? Secondly, there's sometimes an argument that you should put your money into companies that are local to support local investment. It satisfies that. But what does it do? It gets rid of that huge 3% cost. Because And this is possible because contracts, we can now move governance around, we can move all these things around, and we can move risk around. We have risk flows instead of capital flows. Notice, remember, you waved your head, the swap doesn't cost anything. So when the Sovereign Wealth Fund of China and Norges Bank do this deal, no money flows out of China or into China. It's just an agreement. Remember, it costs nothing. So there are no capital flows at all, just risk flows. You've transformed the risk. Okay? Now, you say, wait a minute. What happens when you settle up? Aren't you going to have cash go? Well, number one, you know that when it's going to happen because it's contractual. You may settle up every 90 days, every year, but you know exactly when it's going to happen. You know exactly the amount. And you know that the amount that's being done has nothing to do with whether people are trying to take their money in or out. They have to do it because that's what the prices in the market did. That's the first thing. Because of time, I'm going to speed this up, but I have to get the point so you can see it. Notice the following. We like stability. When does China have to pay Norges Bank on this contract? Remember, China pays the China return and receives back the world return. So it's giving money and receiving money. If it's net giving money, what had to have happened? China outperformed the world. Those are good times for China. It's a right-way contract if you want some jargon. China pays when China is doing well. And the flip side is when China underperforms, as we saw happened, the money flows into China, not out. Quite the opposite of the standard that you usually see while you put capital controls. You don't need capital controls when China goes bad because the money comes in, doesn't go out. In fact, it's better because you're actually getting stabilization because money is actually flowing in when you need it. Now, I could be here all night if you saw the rest of the slides to show you all the other good things about this solution. Much like I try, not to show you that it really works very well. It's a right-way contract. It avoids moral hazard. It doesn't, you can't, expropriation is almost, it's basically not possible. There's lots and lots of stuff. But I hope you see the message here. This is doable. I don't have to create, or we don't have to create one new institution. These contracts have been written for decades. We don't have to create a whole bunch of new. The Chinese and the Norwegians have been doing swap contracts in size year after year. They don't have to get a whole bunch of new, institutions or contracts or experiments. This is not very exciting if you like to see something new in terms of the underlying. It's wonderfully exciting if you're trying to solve a problem. Because if you can use tools that everybody knows, doesn't require a new institution, doesn't require new legal work, doesn't require a whole bunch of other things. That's good when you're trying to get things done, especially in size. I've run way over. You'll have to look at the notes. But I do want to say one more thing. Whoops, I just turned it off. That shows you, maybe that's let's see. Okay. See what you missed? Now, I just put this up here. It's a diversement. We had to stop. The next one's on retirement. And I hope I see just a few of you, or if not, send a surrogate. And thank you very much for your time.
Thanks so much. Thanks so much, Bob, for the enlightening, inspiring talk this afternoon. Thanks for all for being here. And I can say, I think with some confidence, and take the unhedged risk of saying that you really just whetted our appetite for the continuing series of lectures for the Donald Sussman Award. Thanks so much.